Welcome everybody to this very first video, the first training video. I hope you've watched the previous videos on getting oriented and the welcome video and all that stuff. As you can see here, it's a beautiful sunny day behind me, sunny morning here in Andorra. So I'm very excited to get started. Just so you know, I will be looking at you, but I do have notes over here on the side that I'll be looking at from time to time just to make sure I cover everything I want to cover. So if I'm looking around, that's why. So let's get started. And this first video is basically just orienting ourselves. There's going to be some terminology there we haven't covered yet. We will cover it. There's going to be some concepts we haven't covered yet, but it's just to give us an overall landscape view of what are options and how they're used in the financial world. So let's get started. So what are options? Options are basically just contracts, okay? And they give the holder, the buyer, the right to do something. Not an obligation. They have a right to do something. And that's to buy or sell an asset at an agreed upon price at any time before an agreed upon date in the future. So this could be me saying to you, hey, I love your car. I'm going to give you $100 right now, but this gives me the right to buy it for $5,000 by December 31st. Okay, and December 31st comes along. If it's a good deal for me, then I might exercise that option. I might use that option, and maybe you crash the car and it's not worth $50. Well, I'm not going to exercise that option because I have the right to do something. And very simply, that's all options are.
So whenever we're trading or making life decisions, we're always looking for optionality. That is the choice about whether we take an action or not. So for example, do you marry that girl? Or do you dump her for her best friend? You don't want to get locked in too early. Now, it turns out that this kind of optionality, this kind of choice, has an actual money value. And you can get paid to give up that choice, and you can pay to have more choice. And this is the world of options. So it's important to remember that options are tradable. So you can give up your optionality in return for cash, and then you can decide it was a bad idea later on, and you can then go and spend cash to get options. And these options trade in markets that are quite liquid most of the time. In a sense, by buying and selling options, we're making life decisions, but they're not permanent ones. There's always a way to undo what you've done.
So let's talk about how they're used in the financial world. And in the financial world, the term we would use is hedging, but we would call that insurance. And hedging is basically insurance or just mitigating, reducing, or eliminating risk. That's all hedging is you're reducing or eliminating your risk. Same thing you would do if you're buying home insurance or car insurance. It's sort of the exact same idea. So let's just say you happen to buy Bitcoin and you bought it at $35,000 and you own one Bitcoin. Well, your risk on that investment is $35,000 because it could go down to zero, right? You could lose everything. Who knows, right? You could buy what's called a put option as insurance against the value dropping. So in options lingo, you would be long this put contract. Long just means you buy. You bought something. You bought a call, you bought a put. That's all that means. Conversely, the seller of that option, the writer of that option, would be considered short that contract because they sold it. Short just means you sold something to open a position with. Again, we're going to cover all this stuff a little bit later. So here we are, we're saying you've bought some Bitcoin at $35,000 and you bought a put option as insurance and you bought it with a $35,000 strike price. Now that strike price is simply the fixed price at which the owner, the buyer of that option, can sell that underlying asset at, in the case of a put option. Now buying this put option gives you the right, not the obligation, to sell that Bitcoin at that agreed upon price, which is $35,000, up to a specific day. So that could be for 30 days, it could be for a week, it could be for 6 months, it could be for whatever. So you can simply think of this as insuring yourself for a specific period of time, up to $35,000, if the value of that asset of Bitcoin drops. Just like you would insure your home or your car up to a certain amount, a value amount, in case something bad happened, right? Now, this would completely insure you in the event that Bitcoin goes down in price because you insured yourself for the same amount that you happen to purchase it at. So if Bitcoin falls to $25,000, you can sell yours for whatever that agreed upon price was, the strike price, which was in our case $35,000, insulating you from the loss. Now, someone without this long put option, who didn't buy a put option, basically they're uninsured, would experience a $10,000 loss in value. $35,000 what you bought it at, the value drops to $25,000. That person would experience a $10,000 loss. That sucks, right? So I think we need to ask ourselves, who is this person on the other side of the transaction? Okay, let's say you bought this insurance. Well, who's selling you this insurance, right? Who's short that options contract? Now, when you buy insurance for your car or your home, you go down to the insurance agent or however it works in your country, and you buy insurance. But with options, there's simply another trader on the other side of that transaction. It's not an insurance company, just another trader like you or me who's selling that. So that seller is someone who's willing to be paid up front and receive what's called a premium to essentially take on your risk. Sounds pretty risky, right? Well, yes and no. What the seller is doing is really no different than what a car insurance company would do. So if you buy insurance for your home or your car and nothing bad happens, which I hope is the case, well, what happens? I guess you have a feeling of peace of mind, but your insurance company walks away with that money. They didn't do a damn thing. They just collected the money up front. They assumed some risk, but most of the time they walk away with the cash. Sounds pretty interesting, right? We're going to be coming back to this whole concept a little bit later and exploring it a lot further. Okay, the second way that options are mostly used in the financial world is what we call leverage, or if you're from the UK, you would call it gearing. Now, the definition of leverage is using borrowed money to increase risk on a trade in hopes of increasing your return. But we're not doing that. We're not borrowing money. Don't worry about that. It's just sort of the standard definition if you look up what leverage is. The cool thing with options is that options have this built-in leverage component. And it really allows users to make virtually the same amount of profit, sometimes more, certainly a higher ROI usually, than they could by trading the underlying asset itself, but using less money to do so. So let's just say you think the price of Ether is going up. You could buy it outright, right? Let's say it's $2,500 at the time. Or what you could do is you could buy a call option at a strike of, let's say, $2,500, the same price it's trading at, and pay a premium of, let's say, $100 to make this, bet. So if you bought that Ethereum outright, you took the cash out of your pocket, or you had USDT or whatever in some exchange, you could buy that Ether outright. And if it goes up a couple $100, up to $2,700, you'd be up $200. I mean, that's fantastic, right? So it's worth $2,700. You bought it for $2,500. You're up $200. Wonderful. Now, if you bought, let's say, that Ether call option for $100, you'd be up $100, because we have to remember we've got the $2,700 current price you could sell it in the open market at, minus the strike price, minus the premium of $100 we had to pay for it. But what's really interesting here is one strategy costs you $2,500 to do it. It's the full Monty. You're buying a full Ether. The other one costs you $100 to do it. So when we look at that size of the return, as a percentage, it's much larger. And that's where that leverage comes in. You've got that built-in leverage that options have. Not to mention the smaller risk, because if you buy that Ether for $2,500, your risk is $2,500 because it could theoretically go to zero. The most you could ever lose on the call option is the $100 you paid. Okay, so let me just graphically present that last example versus just explaining it and talking about it. And I'm going to give a lot of examples visually in the future, lots of lessons. And, I do that because everybody learns a little bit differently. I want to make sure we optimize our learning. Some people are verbal, some people are visual, whatever. We'll just tell tons of examples, and there'll be some repetition, especially with some concepts that some people struggle with. So it's all very, very clear. And of course, you can always ask questions if you don't quite understand. But when we're looking at that last example where we're saying, hey, let's buy Ether. We think Ether is going up. Wonderful. Well, you could just buy some, at $2,500, right? And your profit could go to the moon. It could be worth $3,000 tomorrow, or $5,000, or $10,000, or whatever. It's got unlimited upside. Okay, that unlimited upside profit and unlimited time. I mean, you can hold on to that sucker for the rest of your life. 10 years, if Ether's still around in 10 years, I don't know. But you can hold on to it for a long time to let that happen. But it's going to cost you. It's going to cost you $2,500 to do so, right? And if it goes up $200 to $2,700, like we said, hey, beautiful. We made $200. So now if we look at that call, where we're going to buy a call, what we do here is we would see it basically cost us $100 in premiums. So we bought it. The strike is $2,500. Cost us $100. So $2,600 is our break even. So we needed to go above $2,600 to make any profit. And after that, boom, the profit is unlimited, just like on the other side. But we have limited time. But it only costs $100 to do this, right? This option might be good for 7 days. It might be good for 3 months. I mean, who knows? Whatever. That's your choice. So we made $100 profit. So we made $100 less than on the other side. But the ROI is much higher because we only spent $100 to make $100. So we doubled our money. Here we spent $2,500 to make $200. So when you're buying an option, just like insurance, your risk is limited to the amount that you paid, the premium. And that's the term they use for insurance too. What are your insurance premiums? It's limited to that. If you spent $100 for an option, it doesn't matter what happens with the price of anything. The maximum you could lose is $100. You can sleep pretty soundly at night, not worrying about it. There's one thing to remember though. So I just showed you two examples using cryptocurrency, but options can be used for anything: oil, gold, stocks. It does not matter. There is something called an options multiplier when we're talking about stocks. So one stock contract is almost always going to equal 100 shares. So for example, you have one Apple, AAPL is the trading symbol for Apple. You have one Apple contract that represents 100 shares of Apple stock. So if someone says to you, hey, what are those Apple call options, this certain price trading for, and you say $3, well, that actually means it's trading, it would cost you $300 because you have to multiply 3 by 100 shares. Now, there's another way that options are used, and that is to enter a position at a better price than what it's currently trading at. And this isn't something that we're going to go too deep into in later lessons. We are going to talk a little bit about it. But let's just say you're interested in owning a particular stock and it happens to be trading at $50. And maybe you're nervous to buy at that price. Maybe you're thinking, oh, geez, is it going to go down? Man, I don't know. I don't know. Should I buy it here? Should I buy it lower? I don't know what to do. What you could do is you could sell a put option, maybe short a put option, giving you the obligation to buy that stock at a specific price up to a certain period in time, up to the expiry date. So the stock is currently trading at $50, for example. You sell a put at a strike price of $45 and you receive $1 in premium. Remember, whenever you sell anything, you get that money up front, just like the insurance company. If the price drops to, let's say, $43, well, you're obligated to buy it at $45. But that's a heck of a lot better than buying it at the $50 you were originally thinking about, because you didn't know if it's going to go up or down. Nobody knows what's going to happen. The markets are very random, right? Plus, don't forget, you collected a premium of $1 there. This makes your actual purchase price $44, right? You got the $45 purchase price, the strike price you sold the $45 put at, minus the $1 of premium you collected equals $44. That's pretty good. Yes, you didn't buy it. Let's say 43 happened to be the low and then it went back up or something. Well, we can't time exactly the very lowest price we're going to buy it at or sell it at the very highest price. That's unrealistic. Every now and then it'll happen. Wonderful. Bonus. But that's pretty decent. You got it at a much better price than you're originally thinking about. You collected some premium and you got a decent price. All right, so next up in how they're worded, or how these options are used, and this is what most people think of, and that's speculation. I mean, this is largely because of leverage. Speculation is widely used by traders. That's really the big advantage. And speculators are just betting on price changes. They're thinking it's going to go up, they think it's going to go down, they think it's not going to do anything. Whatever their strategy happens to be, that's what they're trying to do. They're trying to make money from price movement or the lack of price movement. Options are wonderful because they're a huge market. They're very liquid. It means a lot of people trading. It's fast to get in. It's easy. It's inexpensive. And you're tying up less capital than you would if you were buying the underlying asset. And I think here, when we talk about especially expensive assets like Bitcoin we talked about, or Google shares, for example, those are bloody expensive, expensive assets. So if you want to, shell out of your pocket and buy a Bitcoin or buy Google shares or shares that are worth, hundreds of dollars, you're starting to swing a pretty big stick and you're putting a lot of capital at risk versus buying some options. So, here I have this example. Let's say you buy a Bitcoin, it happens to be worth $20,000 that day. Well, you could buy an options contract depending on the strike price and the expiry date. Maybe it costs you $800. That's a big difference. And that's what allows people to get in and out very, very quickly, speculate on price movements, and just generally speculate on the market in general. So there's a lot of ways that options are used in the financial world. These are sort of the four primary ways. We don't have to go crazy into them, and some of the things aren't really applicable to you right now, or the strategies we teach, and they might be later. Let's say you have a really big portfolio and you need to manage that risk. Well, I think that's very, very important. If you've got millions of dollars in stocks and commodities and crypto, well, you know what? I think it's a pretty smart idea to manage that risk, don't you? So we don't need to talk about that in this fundamentals course. We'll talk a little bit about hedging later on in later modules when we start trading. And depending on the type of trader, if you're just doing little tiny small trades, it's pretty basic. We don't have to worry about it. But I just wanted to give you that overall landscape view of how options are used, how useful they are. They're like the Lego of the financial world, right? And they provide incredible utility. And they're very, very important, especially as risk management tools for big institutions. So they're a vital part of the whole financial picture. All right, so that's the end of the first video on what are options. And the really cool thing about options is they're for anybody. I mean, if you're an absolute beginner, if you work at a big fund, you're a sophisticated investor, there's kind of something for everyone in the world of options.
Yeah, so we like to talk about options as being the Lego bricks of finance. You can literally build any payoff, any financial product out of a collection of options. And by the end of this course, you'll know how to. It's actually worth mentioning that not everybody in hedge funds knows options well. In fact, it's quite rare for people to be fully cognizant of everything they can do and all of the payoffs and pricing. By the end of this video, you'll know more than most of the hedge fund industry.